Delighted to be back again this year to address you for the 2014 economic outlook. Last year, as you may recall, I discussed the prophecies from the Mayan calendar, which foretold doom on 12/21/12. As you may recall, I made a very bold prediction. I really went out on a limb, put my reputation on the line, and I said the world would not end. And here we are. And despite Mother Nature's efforts to keep us frozen out, we are here. Yes, give us a round of applause that we were right and the Mayans were wrong.
They may have just been off by a year.
Always the optimists. Here we go. Making your own predictions, I see. So more generally, as you may have recalled from last year and through most of the year this year, we had prophecies of economic Armageddon due to excessively loose monetary policy leading to hyperinflation and asset bubbles. We had concerns about excessively tight fiscal policy leading to concerns about the fiscal cliff, the sequester, to leading to sharp contraction. Well, it doesn't seem we've had either of those things, those bad outcomes, come to fruition. We didn't have a double dip. We haven't seen an explosion in markets. Certainly there are risks that are out there, but I think economic Armageddon is not what we have had. But for accountability's sake, I want to go back to my forecast from last year. Also, of course, it's always very nice to be accountable when you're more or less right. So that's why we'll start off with accountability and transparency to begin. So the fundamentals for my forecast for last year were that the U.S. was going to continue in this sideways slide. That's what I've been characterizing things for the last couple of years, which meant that we'd have growth around low twos percentage points. We'd have a gradual decline in the unemployment rate, but painfully slow, and very little inflation. And that's basically what we've had. We've had growth around 2% since the third quarter of last year. Fairly weak in the first two quarters and stronger in the next couple of quarters. The unemployment rate has come down from 7.8% to around 7%. Sorry? Oh, I think there's a market crash going on right now. And so the unemployment rate moving down rather slowly, stumbling down, we might say, to 7%. As I'd mentioned last year, some of that was likely to be driven by, and it was driven by, just a reduction in the number of people working and looking for jobs, so the number of people that are in the labor force, rather than a fully robust recovery, but it's getting a bit more robust. We're starting to see about 200,000 private sector job growth per month. And I'd also argue that we'd see very little inflation, despite the Fed's balance sheet growing dramatically, now up to nearly around $4 trillion. And inflation, depending on your favorite measure, is somewhere between 1% and 2%, below the Fed's target level for it, and I think below where most people would say that it's potentially problematic. So now, where are we and where are we going forward? Well, for the first time in 2 years, I'm actually going to change my forecast. I'm going to change it from sideways slide for 2014 to a more rapid recovery. So don't quite break out the champagne bottles yet, but I do see a little bit more light in the tunnel than I have over the last few years. What do I mean by this? Well, growth will probably move up from the low twos to perhaps the low threes. We're going to continue to see this gradual slow decline in the unemployment rate, both for good reasons, more private sector job creations, as well as potentially some not so good reasons, just more people staying out of the labor force. And I still see very little inflation pressure, at least in the short to intermediate horizon. But there's some very important risks to this forecast that I want to outline. So my theme this year could be described as foundations for recovery, firm or fragile. I'm going to come out by a hair on the firm side, but I don't want you going away thinking, oh, don't worry, be happy, there are no fragilities out there. Unfortunately, there are a lot of fragilities that are still with us. And that poses a lot of very important policy challenges for my former colleagues at the Fed, as well as other former colleagues in Washington, because we want to make sure that we provide support for this more rapid recovery without generating inflation, or don't pull the punch bowl away so quickly that we can get into the sideways slide again, or have that turn into what Larry Summers and other people have been calling a secular stagnation. Well, This is going to be one of the key challenges that Janet Yellen is going to have. I'm delighted that Janet was confirmed earlier this week, so we will have a Federal Reserve chairman starting February 1st. That's a very good thing to have. I think Janet will be an excellent chair. And what I want to do is, after I go through my forecast, talk a little bit about some of the specific challenges for monetary policy and some of the challenges that Janet is going to be facing. Also, given our new timing this year, it just so happens that the minutes from the most recent Federal Reserve meeting will be coming out at 1 o'clock Chicago time. So after I sit down, I'll be listening with one ear to hear what Austin and Carl have to say, and I'll be looking with one eye to see what the Fed minutes have to say, and hopefully can have some real-time commentary on that. Well, what I want to do is think about a few different pieces, actually 6 different things that both the Fed has talked about that I think are quite relevant for thinking about the economic situation. And it's also instructive to look at these and how they've changed over the year, and particularly since September, because the Fed did a little bit of a head fake. Most people thought that the so-called taper, the reduction in the pace of asset purchases, was going to happen in September. It didn't happen in September, it happened in December. And I think these are things that we'll see in the minutes, or I presume we're going to be seeing in the minutes, but are also things that the Fed has talked about what they're looking for in the economy, what they're looking for in the strength of the economy, to be able to feel comfortable, continue to reduce the pace of asset purchases. Well, first, the Fed has talked about, and we all are very focused on, thinking about sustained progress in the labor market. And of course, it's not nearly as much progress as anyone would like. As I mentioned, labor force participation rates are still quite low. Actually, we're down to the level of the summer of 1978. Anybody remember that Barry Manilow song, The Summer of 1978? That's great. Very few people do. That's a sign of economic progress, that we've forgotten about Barry Manilow. I, unfortunately, grew up in New Jersey listening to Barry Manilow in the summer of 1978, so it's with me, but I'm glad that it has not left the same legacy with everyone else here. Hopefully we can make some progress not only on the Barry Manilow front, but on the labor force participation front. Obviously, with an aging population, we're going to have lower labor force participation than before, but the real question is what's happening not just of older workers, but younger and middle-aged workers. Because if you actually drill down into the data, and some of my colleagues like Eric Hurst has done this, what we're seeing is older workers are actually working more than you would expect. Younger people are not entering the labor force as much as you would expect, and we're not quite sure exactly what's driving that, whether they're seeing there are not very good opportunities and not engaging the labor force, or whether they're sort of following the Marxian ideal of being fishermen in the daytime and poets in the evening. We just don't have quite the data yet. But that's a concerning trend, because obviously we will need younger people to be entering the labor force in order to deal with Social Security, Medicare, Medicaid, a lot of other things. So that's a challenge going forward. But we are making some progress in the labor market. And that's one of the issues that was different in September versus December for the Fed. When Chairman Bernanke started talking about the potential for a step down of asset purchases in 6 to 9 months, the labor market was looking very strong. It started to have its, unfortunately, now it's becoming traditional spring or summer swoon. It seemed to be a step down, and so that raised some concerns about their stepping down in the asset purchases, but then more robust data in December. Housing recovery. That is something that has been moving along. It stalled a little bit as interest rates zoomed up after the chairman started talking about the potential for the step down in asset purchases. But hopefully we will see the housing market recover continue to remain robust despite the higher interest rates. Certainly, I think it'll be at a lower level. We were seeing growth rates of 15% in housing prices in many areas. We probably won't see that this next year, but I don't see signs of a turn down. That's good for people's wealth, good for people's confidence. Third, there's been a little bit of a reduction in fiscal uncertainty, and that was a big issue that weighed on the Fed in September versus December. Remember, we had the fiscal follies, or I call them the fiscal follies in October, of all the potential for shutdown and default, and that's not good for anyone. That's not good for the economy. It's not good for either the political parties. And actually, they seem to have realized this, and now we have at least a little bit of a truce. And so instead of Act 2 of the fiscal policy opening this month or in February, that's likely to be put off. I think that's something that is very, very helpful. My colleague Steve Davis has done a lot of work on the effect of uncertainty on economic outcomes, on the willingness to invest and hire, and he has found very significant impacts of this increased uncertainty, particularly on the fiscal side, weighing very heavily on business. Fourth, reduced international risks. We're seeing some more robust numbers coming out of Europe. Well, I think there's still some risks there. China remains a question mark, but if you look at September versus December, fewer risks in Europe, and China seems to be a bit more stable. Inflation continues to be, inflation expectations continue to be very well anchored. There had been more concerns about deflation back in September. Certainly inflation is running below where the Fed wants it to be, but the Fed is reasonably convinced that this is temporary. I think there's still many unanswered questions about why inflation is running as low as it is, but I think there's more confidence that even if they step down the asset purchases, we won't slip into a deflationary state. And also there's some concern about some frothiness in the markets. Spreads on junk bonds and other risk spreads have come down dramatically, and so the Fed is a little bit concerned about that, wants to pull the punch bowl away a little bit to take some of that frothiness out of the markets. And overall, that's led to an upgrade in the forecast. What happened back in September is they were putting out a forecast and they were downgrading their forecast. So the Fed says that it's data-driven, forecast-driven. So how could they have been taking a step down in September at the same time they were saying that the economic forecast is stepping down? It's not consistent with their overall approach. Now, certainly they try not to surprise markets, and I think they had built expectations up of a step down, but they had this tension of what were they going to do, and the decision was, well, we've got to stick with the data-driven and forecast approach. I think that was the right thing to do, and they took the step down more recently. I think Janet Yellen was very much on board with all of this and this whole approach. She's very much a data-driven and analytics-driven person. When she was head of the San Francisco Fed, when I was at on the Federal Reserve Board, she would come in and each meeting she would present data and analysis. Some regional Federal Reserve Bank presidents come in and primarily talk about anecdote, about, they've talked to a CEO in their district or they have some particular activity in the district that they talk about. She would talk about national level things. She was always thinking about the broader economy, always data-driven, always analytical. She's been battle-tested. Man, we've been through a lot of closures of thrift institutions in her district. Together, I was chairing the Supervision and Regulation Division. She was chair of the San Francisco Fed. She was very careful and very engaged in those issues. And I think that's very important that she has been, because what was quite interesting in her confirmation hearing is that the focus was much more on regulatory issues than it was on monetary policy. There have been these concerns that somehow she was some knee-jerk dove or some super dove. I think that's completely inappropriate. She's a data-driven person and she wants to get to the right answer. But it was very interesting that so many of the questions were about regulation. And I think that's going to be something that will be a very big thing for the Fed and for all of us to be dealing with going forward. And I think it's one of the key fragilities going forward. She's someone who can make very strong arguments and make very good arguments. She can listen to arguments, but I think she'll be a little bit less tolerant than Ben in allowing some of the discussions that she sees as not very helpful to occur. I think she's going to be a little bit tougher there. Not dramatically tougher. You're still going to hear a lot of different points of view, which I think is broadly positive. But I think she may be a little bit tougher on that. I think one of the key things that has happened to make the exit a bit easier for Janet is a change in the market behavior and the market reaction to both data and to Fed statements. So we know that when Ben started talking about these issues, about what they would do, as you know, last year I characterized this as open mouth operations rather than open market operations, because you're opening your mouth about what you will do rather than the actual purchases or sales of securities. Well, it was a little bit of foot and mouth during that time period because, of course, there was a lot of confusion. Interest rates shot up. The Fed didn't want them to shoot up. They tried to talk them back down. But generally what's been happening until recently is that good news has been bad news. So when you get a strong employment report, the market would go down because they say, oh my goodness, the Fed's going to pull away the punch bowl. And that's problematic because what that means is the market participants are thinking the Fed is much more important than market fundamentals. But there was a change that happened the beginning of December, and it'll be interesting to see when the employment report comes out this coming Friday. We had a solid employment report, and good news was good news. The stock market went up, and the 10-year rate hardly changed. And so it wasn't that people suddenly thought, oh my goodness, Fed's going to pull away, interest rates are going to skyrocket, and the economy is going to tank. We'll have one of those spring and summer swoons again. They're saying, well, maybe the fundamentals are there. We don't need the Fed to support. And that's actually crucial in making monetary policy because obviously the Fed doesn't want to disrupt the recovery that they've worked so hard over the last 5 years to try to bring to fruition. And the markets now seem to allow them to do that they can take the step down and the markets say that's legitimate because the private markets, the productivity, economic growth will be able to do it on its own. Obviously, we're going to have another test this coming Friday, but I think that's an important, a very important change and one that's going to be very, very helpful, very helpful going forward for the exit strategy for the Fed. Quickly on the fragilities, there's still a lot of fiscal uncertainty that's out there. We haven't put it all behind us, at least in the short run, we've put some behind us. There still continues to be extreme regulatory uncertainty. Obviously, what's happened with healthcare has not been good for hiring. It's not just the cost involved, that's part of it, but it's the uncertainty about those costs, uncertainty about what the rules are, uncertainty about how you're going to be dealing with employees. That is not helpful during this time period. There's an enormous amount of uncertainty about regulation both in the US and abroad in the financial services area and particularly in banking, and so what credit availability is going to be. As I mentioned, this is going to be one of the key things that Janet is going to have to focus on. Another fragility is the rest of the world. We've had some very strong export numbers that have come out, and are probably going to lead to very strong growth in the fourth quarter. But there's still a lot of fragility that's out there. A big step down in growth rates from a number of emerging markets, particularly the so-called Fragile Five of Brazil, India, Indonesia, Turkey, and South Africa. After the Fed started talking about the step down has now occurred, and some of these countries are having some major challenges. Raghu Rajan, on the panel last year, my colleagues and friends and co-authors, is now head of the Reserve Bank of India, and he certainly has his hands full because not all countries are experiencing low inflation. Brazil and India actually experiencing high inflation, and that's a very important warning that although we've been experiencing low inflation, inflation is not something that's behind us. Inflation still can rear its ugly head. Brazil and India, very large and important countries, are experiencing that, and Alexander Tombini and Raghu Rajan, the heads of their central banks, are having to deal with these issues. I don't think we're likely to have to deal with that in the next year in the U.S., but it is something that we have to remain ever vigilant about. Well, I began with a prophecy, and so let's end with a prayer. A variation on Reinhold Niebuhr's so-called Serenity Prayer, adapted for modern central bankers. And so we can talk about Ben, we can talk about Janet, we can talk about Raghu. So grant Ben, Janet, Raghu the serenity to accept the things he or she cannot change, because there's some fundamentals in the economy that are far beyond what monetary policy can do. The courage to change the things that he or she can, to make sure that you avoid deflation as well as avoid high inflation, and the wisdom to know the difference. Thank you very much.